Hi, I'm Aoife and welcome to Fiftyfaces TV. I'm joined today by Peter Kent, who is co-head of fixed income at 91, a global asset manager with over $150 billion in assets under management. I've interviewed a number of guests from 91 for the Fiftyfaces podcast, and I was particularly intrigued by an article that Peter wrote recently where he described the EM-ification of DM debt, so the emerging market-ification of developed market debt. I was particularly interested in digging into that, so I invited Peter on the TV. Welcome, Peter. Thanks for joining us here.
Thanks for having me.
Well, let's get straight into that article about the EM-ification of DM debt. What exactly does that mean to you?
If you recall, you and I were on a panel a couple of years ago at a fixed income conference in Chicago, and that's when I first presented it. The idea actually arose in September 2022. We were sitting at an investment leadership offsite at 91 in London when the gilt crisis was happening. If you recall, Liz Truss went for an unfunded dash for growth. And gilts essentially unhinged, especially in the back end of the curve. I think they sold off 100 basis points in a day, a cumulative 200 basis points. Now, in my 25 years of managing bonds, about half of those have been in the developed markets. I used to trade gilts. I used to trade euros and dollar swaps as well. And the other half has been in emerging markets. So when I saw this gilt crisis unfolding, I think the first thing that I thought was, thank goodness I don't trade gilts anymore, because that looks crazy. And the second thing I thought of, well, this is a move that emerging markets would be proud of, to be honest. It was an emerging market-esque move. And we were deliberating this as an investment leadership. And I just said, what we're seeing is developed markets are EM-ifying. The volatility and liquidity that we're seeing in developed markets are on a par with emerging markets. Gilts were the sort of canary in the coal mine. And since then, we've seen a few shoes to drop. We've seen the bond market a couple of months ago on the back of the fiscal expansion for defense and investment expenditure. We saw certainly the biggest move that I've seen in my career in the bond market, and it was a bear steepening led by the back end. A bear steepening is something that's normally reserved for emerging markets, but it happened in the gilt market, it happened in the bond market, and we've seen it more recently with treasuries as well. As sort of policy credibility has been questioned there. As people worry about fiscal sustainability, you've seen a bear steepening in US Treasury market as well. So it's the EM-ification of DM is a new volatility regime for developed markets, a new liquidity regime for developed markets. And in a world where EM has all of these sort of stigmas attached to it, the idea is just merely to sort of set the record straight and make sure that people think about EM when they have, when they consider their bond portfolios.
That's fascinating. And I suppose if we were to get to some of the root causes of that increase in volatility in DM debt, what would you say that they are?
Look, I think the first thing I would say is, given I've spent roughly half and half in EM and DM, I try and sort of keep myself honest and not sort of, be an EM cheerleader. So the first thing you've got to say is EM is still volatile. It's an asset class, especially in local, where the volatility is a couple of times more than sort of DM. It's just that the volatility change has been so remarkable. DM fixed income has had a significant volatility change that's stuck, whereas EM has kind of behaved as expected throughout this whole thing. So what are the main reasons? I think policy orthodoxy is key. If you recall, way back when the inflation transitory bogey, when inflation turned up in developed markets, they called it transitory. When it turned up in emerging markets, they did what they had to do and they hiked rates. So, you had a sort of compounded bond effect of an interest rate hiking cycle that was potentially quicker, later, and more pernicious than it could have been. And I think that was clearly one of the factors. One of the other factors, as we've spoken about now, is and it's an orthodoxy point as well. It's a fiscal orthodoxy point. Is you've seen quite a lot less fiscal discipline in the developed markets than you have in the emerging markets. And EM had its really bad time around the taper tantrum. EM had a bunch of external imbalances in 2013. It spent a good 3 years after the taper tantrum sort of rebalancing in general, and as a result of that was more resilient. So I would say those are the main factors. One of the key factors that sort of dawned on me in the last 6 months to a year, and I think it actually has broader implications other than fixed income, is the nature of the shocks, economic shocks that are hitting the global economy. In my career, I've pretty much got used to demand shocks. I think the whole economic community has got used to demand shocks, and policy response to that. Analyzing demand shocks is relatively simple. Whereas the nature of the shocks that have hit the global economy in the last 10 years now, I guess, have been supply shocks. Those are hard to quantify, and importantly, so I'm talking things like Brexit, I'm talking about the Russian-Ukraine war, I'm talking about COVID, and more recently tariffs. The thing about supply shocks is growth and inflation move in the same direction, which makes that sort of correlation between defensive and cyclical assets a lot closer. And I think that's one of the reasons why DM has also struggled, is the sort of nature of the shocks that are hitting it has meant that it hasn't been behaved defensively. So even though volatility is higher, I think what's also disappointed people is DM fixed income really hasn't been a defensive asset throughout all of these things.
Very interesting. And I'd love to ask, where does this place EM then? We often speak about heuristics and EM having different country risk and different geopolitical risk that needs to be priced into the return we expect. But it has been said that EM perhaps has shifted recently, that they are perhaps used to inflation. So therefore, there was less of a need to completely rewrite the rule book when it comes to dealing with extraordinary inflation. And also that their institutions now have stood the test of time. Over many years, they have already been tested by some of those more challenging circumstances. So I'd ask, I suppose, where does this place EM, and are our heuristics right for EM? And then equally, is EM even the appropriate term in the first place, this overarching umbrella term?
EM is close to sort of 80 countries, so you're always going to get your basket cases, right? So you kind of need active management to thread your way through, the many countries that are out there. But you've generally seen better fiscal discipline on average. You've seen an improvement in external balances. EM also went through its default cycle in COVID, so a whole bunch of value appeared then. The developed markets really haven't been through their default cycle. I think one of the interesting things to contemplate as a DM investor is central banks always came to your rescue in the past whenever you had sort of credit vulnerabilities in the market. With inflation doing what it's doing, can you really sort of rely on the Fed and the ECB to come and sort of bail you out like they did in the past? I think the answer is yes, but they will definitely be asking more questions in the past. So I think that is a reaction function thing that one has to consider. The other thing to think about in EM, as you say, like EM today is kind of not your grandfather's EM. Like EM started way back when with Brady bonds with huge yields. Very illiquid, largely sort of dollar denominated. A local market has evolved over time. The reason that local market has developed and become so big is because monetary policy has become credible. So people are willing to lend in sort of emerging market currencies. So that monetary policy credibility has underpinned that. And the quality of the benchmark has improved, right? We've had a bunch of Asian countries come in, which have improved the volatility profile of it. The quid pro quo of that is the yield has gone down to some extent. So people look at local and say, wow, the pickup's not as good as it used to be. Well, it's because it's higher quality, and EM locals actually outperformed a lot of DM over the last 6 months to years. So you're seeing that sort of quality come through. So yes, EM, generally, you've seen more orthodox fiscal and monetary policy. As a result of that, you've seen an improvement in local currency issuance. So countries aren't as susceptible to the original sin of lending in dollars. You get a higher quality index for that, which means better volatility profile, better diversification profile. The quid pro quo is you get slightly less yield. The way that our clients essentially square that circle in the more recent times is they think about sort of EM in the traditional sense, with the indices, the traditional indices. But if they want sort of their grandfather's EM, if they really want something high yielding, super cyclical, macro adjustment type stories, they will then dabble in frontier. They'll add a little bit of frontier as well as a sort of barbell strategy to traditional EM.
And that was my last question in terms of what this means for the global debt investor. Do you find that they are maybe rethinking some of their expectations around DM and some of the return expectations they would have for that? And equally, how are they thinking about their EM allocations in this context, given that perhaps DM and EM are starting to converge?
I think the first thing I've got to be honest about is, EM local currency post GFC has been, it's generally been a disappointing asset class for the average dollar investor. Like, for a sterling Canadian Antipodean investor where the currency is a little bit more cyclical, the experience has been different. But the dollar investor, it's been a sort of tough ride in local for a decent part of the post GFC period. And that's because of what I call the dollar shadow. The dollar kind of moved in a straight line rally from post GFC. That was because, the US was really the only place that was growing through that period, and it cannibalized capital. So it made complete sense. Is that going to persist over the next decade? Unlikely. So I'm not going to join the dollar pylon that sort of seems to be happening in the market at the moment. But I think what you can say as an EM investor, as a minimum, is the dollar's not going to do what it's done for the last decade. As a minimum, it's probably going to go sideways because nominal growth is probably going to be shared a little bit more over the next decade than it has been over the last decade. We're going to see way more investment in defense. We're going to see much more fiscal expansion across the globe. So I don't think nominal growth is going to be in such scarce supply as it was post GFC. So I think the first thing you can say is I don't think the dollar shadow is going to be there like it has been in the past. That's a very important implication for investors. So that then brings sort of EM into the picture better than it has done over the last decade or so. I think the other thing to consider as an investor is the nature of these shocks. I think the fact that we're dealing with supply shocks a lot more than demand shocks in the past has changed the nature of interest rate risk. Interest rate risk used to be a fantastic tool in a balanced portfolio. It would protect you against deflation risk. Growth and inflation was negatively correlated, so it was a fantastic diversifier. You've just not seen sort of fixed income behave defensively, DM fixed income behave defensively like that. So I think allocators need to think about interest rate risk too. So for me, the overall point I would make is the next decade's not going to be the same as the last decade. So investors need to spread their money far and wide. And diversification, I cannot remember a time in my career where diversification is such a virtue. I would love to say you need to diversify to pick the winners, but I think given the way the world is going geopolitically, you need to diversify also to just avoid the losers. There's quite a lot of random losers out there that you really don't want. And diversification on sort of dimensions you haven't really considered before. We've always thought about region, currency type, whether it's sovereign, whether it's credit, etc. But I also think you've got to think of the role of interest rate risk in your portfolio too. So for me, that speaks to a much more global fixed income portfolio, one where emerging market is at the table, and potentially an unconstrained type portfolio where interest rate risk isn't the sort of backbone of it.
Well, thank you so much, Peter. Lots of food for thought there. And I would say that the truism around diversification being not for what you expect to happen, but for what you do not expect to happen is certainly very clear. The other thing I'd say is that from dollar supply to supply shocks, you've given us plenty of food for thought across the spectrum. Thank you so much for coming here and for sharing your insights with us.
Well, thank you so much for having me.
This is Aoife and Devitt. You've been watching 50 Faces TV.